Steve Leisman joins us now with more on those efforts. We have not seen anything like this, Steve, in a long time.
No, but Tyler, that was an excellent explanation. And while the worst has been avoided, it appears both banking stocks and fixed income markets trading with continued uncertainty, continued concern over whether enough has been done to fix the financial system. Krishna Guha of Evercore ISI writing today, banks will remain under pressure from less stable and more expensive deposits. Attention will also turn to other parts of the financial system, including insurers and bank interest rate swap counterparties carrying large unrealized mark-to-market losses. Concern about the economic and financial fallout of SVB's demise showing up in a massive fall in the outlook for Fed rate hikes. The year-end funds rate now trading around 4%. Folks, last week it traded as high as 570, so 170 basis points of expected easing has now come to the into the market. Here's what's been done, just to underscore what Tyler said. The guaranteed deposits at SVB, including the uninsured deposits, creating an implicit but not an explicit guarantee for other uninsured depositors at banks. They shut down Signature, created a new fund at the Fed to finance bank assets, and they eased lending rules at the Fed's emergency discount window. So there are two opposing impacts on the economy. Lower rates, including lower mortgage rates and higher valued bank collateral, could be inflationary, could help economic activity, but a need for banks to pay higher interest rates to depositors and overall uncertainty in the financial system could dampen the economy. Tyler?
You know,
Kelly?
Steve, one of the great lessons of investing always is to diversify. But this seems to be a bank whose corporate treasury did not diversify sufficiently. In other words, they had too much of one kind of security, and that would be long-dated treasuries at precisely the wrong time. That is one of the things, but not the only thing, that's at the heart of this debacle.
Tyler, I hate to correct you in an amusing, somewhat amusing way, because they also had long-dated mortgage-backed securities, a lot of that too. So they made two mistakes. They had that, they failed to hedge it as well. Long-dated securities. Yeah, I just wanted to add that it was also mortgage-backs and treasuries. And the importance is they didn't have a diversified depositor base. They did not hedge the risk, and they also had a large percentage of their deposits were uninsured, so very flighty deposits. There were at least four things that went wrong. It's unclear to me why so many companies kept so much uninsured money at this account. The question is whether or not having the Fed's blessing and the Fed not saying anything or the supervisors not saying anything made people feel confident in this bank. It was indeed the 16th largest, had $209 billion of assets. Everybody did banking there. If you were, as you said at the top of the segment, Tyler, if you were in the business, you did your banking at Silicon Valley.
All right, Steve Leisman, thanks very much. We appreciate it.